Is Australia heading towards a housing bubble? Now, this is a very different type of video that I don't normally do on my channel, but I feel like this question has recently been coming up, and a lot of people are FOMOing out, and a lot of people are concerned about when the next housing crash is going to be. And quite honestly, I don't really think about these things. And that may seem a little bit counterintuitive, but the reason I try not to think about these things is because you hear every second week about a housing crash, about something in the media complaining about housing is too expensive, it's going to crash, it's inevitable. Some economist, some expert is always complaining about something. And so generally, I've taken a big step away from social media because when it comes to my fundamentals of investing, I buy and hold. And so the day-to-day fluctuations don't really matter to me. In fact, the year-to-year fluctuations don't really matter to me. All I care is that my house price goes up and that I'm able to pull equity out every so often so I can reinvest that money into wherever I choose. And so before I do start this video, I really want to make it clear that I am literally just some person on the internet sharing what I'm seeing and how I think about things. This isn't financial advice. Of course, do your own research, talk to your professionals, and make decisions that are right for you, right? At the end of the day, investing is a risk. We all take a chance because we all want a better future. Some people take bigger risks, some people take smaller risks, and the people who sit on the sidelines usually end up nowhere. That's the truth of it. So let's talk about things I've generally been seeing. Number one, we are living in high investor confidence environments at the moment, right? We are seeing a lot of people who are over leveraging to buy property, and they are over leveraging more than they can realistically afford. With interest rates falling, with more buyer confidence coming to the market, people are stretching their finances to the absolute extent to be able to purchase 500, 600, 700k properties in bulk. Now, what's interesting as well about people who over leverage themselves is that these people are usually more emotional buyers. And that's a big issue because emotional people aren't able to make sound investment decisions. They get caught up in themselves. They get caught up in their emotions. They're not focused on the long term, or they're not focused on the right aspects of property investing. And this touches into the second point as well. But a lot of people who are borrowing on 5% deposits are already stretched very thin. I think personally it's quite stupid if anyone purchases a property on a 5% deposit because they are borrowing 95% from the bank. And then if that house price were to fall by a little bit, you could be in the possible territory of negative equity. Now, my limit is 12%. Some people go to 10%, but I really don't recommend anyone below 10% because you are putting yourself in a really risky position. And it only takes 1 or 2 interest rate rises to put you in the red pretty badly. So people who over leverage, be careful. Number 2, emotional investing. Social media is fueling a wave of emotional buying. In fact, even I have a certain amount of influence at this point in time where people might watch my videos and invest into a certain location purely based off what I said. That is silly. Please do your own due diligence. Think about what you're purchasing. Think about the person who creates the video's intentions, the person who creates the ads intention, the TikTok reels you see about promoting an area. Think about why they're promoting that area, right? Sometimes when you see success stories, a post about someone doubling their property value in 2 years or buying 5 properties before 30, it creates hype and urgency, which you don't need. Property investing is a long-term game. People who are in the short term will lose out big, right? And if you follow this hype, you will make poor decisions. That's a fact, right? The people who buy 5 properties before 30, I guarantee you they are on 80 to 90% LVR. Basically, their portfolio is 90% debt. Now, it's great that they bought so many in a short period of time. Absolutely. But they have to then hold that property and then hold it long enough so that that debt starts to reduce and consolidate and the equity starts rising. And we don't even know where they bought these properties. Are they in crappy mining towns? Are they in actually a good location? And in fact, it's not even the number of properties that's important. It's about the portfolio value and diversification that truly matters. Are you buying in good locations? Are they good quality properties that you can hold for the next 30 years? Some properties in 5 years' time won't be able to stand by itself without having some rework done to it in terms of its stump, interior, etc. So all the social media stuff online, it draws you into emotional investing when investing should be done on data, facts, and logic that is in tune with your goals and strategy and risk appetite. Anything else is a poor decision. Another thing we're observing in the market is an oversupply of buyer's agent. There's a buyer's agent every second corner that you look now. It's a signal. It's a signal that the industry has rapidly grown because there is an increase in demand, but that too many players are chasing the same pie can also be a warning sign in the market. And the reason I say that is because when you have too many BAs, they can influence a market like you've never seen before. And we've already seen this with small regional towns that really have no realistic fundamentals exploding in price growth simply because there's more buyer's agents in the area. And that's a real big problem, right? Because when those buyer's agents leave, we will see prices come back. They will stagnate or they will fall to more affordable levels of local residents. That is the nature of it. Number 4, rising investor confidence. Now, I've touched on this on the other points as well, but investor confidence is absolutely in the rise. I see that within my community. I see that within Google research trends. Many investors are back in the market, expecting growth to continue on the back of population growth, undersupply, strong rental demand, as well as interest rate drops and government stimuluses. It comes back to the age-old quote, be fearful when others are greedy and greedy when others are fearful. Now, that's not to say that in this current market, there aren't an abundance of opportunities to purchase good quality assets, but it's those people who purchase bad quality assets on low yields who build an unscalable portfolio that will lose out pretty big. In fact, I saw this image on Facebook and it's what's sparked me to create this video. And in fact, you can see the Google searches trend for investment property has drastically increased over a very short period of time. That is a sign of increased investor confidence, not necessarily a sign of a bubble, but you can definitely see there are more investment properties being looked at and searched at online. And it's not only that, I have another image to show you changing times. When you look at this bank from Combank, it is a sign the market has effectively changed. When a bank itself is promoting to rent vest, that is a very scary situation because banks are no longer promoting home ownership, but they are essentially promoting home investment. So they're gearing up for property prices to increase as well. Now, of course, they do that anyway because they're a bank and they want their values to go up. However, 5 years ago, this would not have been a thing. In fact, rent vesting wasn't even really a thing. It's only a small group of investors who knew about rent vesting. But in today's day and age, because of BAs, because of YouTube, because of social media, rent vesting has become the new go-to thing. And that's another sign that there is a rise in investor confidence. And I've talked about this before. Falling interest rates. Falling interest rates always brings more buyers back into the market, whether that's investors, whether that's owner-occupied, etc. Falling interest rates will increase the amount of borrowing power people have, and that will push prices up. Now, the next one I want to talk about is government inaction. Now, governments will never solve the housing crisis. And I quite frankly believe that is the case, especially in the next 4 years, nothing really will change. Governments always talk about solving the housing crisis, but they work on a 4-year structure. Every 4 years, they need to win as many votes as they can. And the easier way to win as many votes as you can is by actually solving the demand side rather than the supply side. And they can win votes by providing stimuluses to a small number of people than it is actually to solve supply, because supply takes a long time to solve and then a long time to actually see the effect of. So stimuluses like the 5% home grant by the Labour government only increased demand, didn't increase supply. And that only pushes house prices up. And it's a short-term fix, but not a long-term solve. And then there's the lack of new housing supply. We are getting better and better with new housing construction. We're seeing this across the board. However, we're still severely undersupplied. We also have rising construction costs from materials as well as trades. Skilled trades are extremely expensive these days. We are undersupplied on skilled trades and we don't have a solution for that. Not many people want to go into trades, plumbing, electricians, bricklayers, roofers, etc. There's a severe lack of skilled trades, which means costs are only going to rise. So if you're buying in that 5 to 600 to 700k price range, you're getting a good valued property because replacement costs are usually higher. But all these points, until they're really solved, are still going to cause house prices to increase. And without getting too political, because I hate getting political, it's a wormhole I don't want to go down of, is high immigration. Now, quite frankly, with the Labour government involved, we will not have low levels of immigration. We will continue to have sustained high levels of immigration at record levels, which means more people will need new homes, but supply isn't keeping up, which means that demand is going to be through the roof, and that means it's going to cause house prices to increase. And immigration, unlikely to be touched by the Liberal government. They might bring it more controlled, but it's still going to be high. So overall, I believe high immigration is not going to go anywhere, which is still going to continue house prices to increase. So when people say that Australia is heading towards a housing bubble, there will be clear signs before it does head to a housing bubble. And right now, those signs are very questionable because on one side, we have a lot of investors coming to the market. Yes, that increases prices to a very unaffordable level, but then we also have a severe need for housing, and we don't have enough houses, and we have record levels of immigration, and we have falling interest rates. It's all combining into something that needs a little bit of correction. Now, this is where it's important, right? I honestly believe that corrections are normal. It's a normal part of any market cycle. A reset keeps things sustainable. A lot of locations, if you've looked across Queensland, you've looked around WA, you've looked across other parts of Australia, property prices are still increasing to extremely unaffordable levels for local residents, right? In some locations, we're seeing house prices in regional areas equal the house prices of capital cities, which is not normal. We would expect regional areas to be cheaper than capital cities, but that's not always the case. And honestly, I do believe that prices need to correct about 5 to 10% in certain markets, or they need to stagnate for a while and allow yields to increase and affordability to rise once again. Markets have grown 80, 90, 100% over the past 3 to 5 years in some locations. If those markets corrected 5 to 10% and stagnated for a while, that's a good thing for that market because it will allow for those yields to come back, affordability to rise once again for local residents, and actually be able to sustain those prices. Because at this point, I really do believe if investors pulled back, those regional locations that have doubled and tripled and quadrupled in some parts are really going to struggle to be able to sustain those prices. And the people who get in late in those markets will lose out. And so I don't think that the market itself is going to have a huge downturn in 2026, maybe not even 2027. But starting 2028, when prices have really grown to very unaffordable level, investors no longer see the opportunity because yields have drastically reduced and that prices have gone sky high. Those markets will no longer be attractive for investors. They will pull back, and then we have to rely on the owner-occupiers of those regional locations to be able to sustain those prices. And when they can't, we will see the market stagnate and start to pull back a little. And that's okay. That's normal, right? But here's the thing. Over-leveraged buyers will lose out. Those who stretched beyond their means, who cannot handle interest rate rises, who cannot handle 90% debt, those people will lose out. And it's usually those over-leveraged people who are the most emotional buyers and who are the first ones to sell without holding in tough times. So it's really important to understand that you need to have cash buffers in place. You need to have an emergency fund. You need to understand that if interest rates rose by 3% today, can I be able to hold the property? If you can't, then you should be really asking yourself, should I be investing in property today? There's no point buying a property if you can't hold it for the capital growth. It's important to understand that. But I do think that when the housing correction does happen or it stagnates, it won't be as bad as people think. Construction costs in this day and age are so high. It costs a lot of money to replace an existing home around the 5 to 600 to 700K mark. And so if you're buying over at the inherent replacement value with land, that property should not lose that much value. So those early buyers that in the 5 to 600K price range, the 650K price range, you have a much better foundation. It's a much safer investment, in my opinion. And overall, you will do well if you hold it for the long run. So then this comes down to the final part that I want to talk about, which is my fundamentals. Because somewhere along the line, I think with all the social media, I've forgotten to talk about why I invest, what I look to invest into, and my actual fundamentals. Because I cover a lot of regional locations, some that I may not even consider as an investment, but I make that clear in the video. Let's go through them. Number one, good regional locations. Now, it can be capital cities as well, but the capital cities, the yields don't really stack up anymore. Like Perth made a lot of sense back in the day, but in capital cities, the yields aren't as good as anymore. And so I prefer strong regional areas with diverse economies, healthcare, infrastructure, public administration, safety, retail trade, finances, services, etc. Those diverse economies, I want good infrastructure and I want there to be consistent demand. If there's a hospital project happening, I'm very more inclined to invest into that location compared to a location that found that there's a new mine in the area. And these regional locations do often have better yields and less competition than capital city hotspots. But in this day and age, I would say the competition is quite spread out and it's all very competitive. Number two, value-based investing. I look for property priced below intrinsic value where the numbers stack up and not just hype or speculation. I don't really care too much about what social media says. I don't care what the BAs are buying, to be honest. I look for properties that I can hold for the next 30 years with minimal issues. And I look at the price point of it and be like, okay, is this an affordable price point for local residents? Do the yields stack up on this property? And is this a good deal? If that doesn't make sense to me, I'm not going to invest in that location. Yes, I look at the micro data, as I say in point number 4, but I also look for value. When you buy something of good value, you're setting yourself up for success. Number 3, decent to high yields. Yields matter. Cash flow matters. Now, that doesn't mean I'm going to go buy an apartment, a high-rise one in South Bank in the middle of Melbourne. No. A solid rental return helps cover the holding costs and makes a portfolio scalable. People with big portfolios, they have decent yields on their properties because it allows them to scale without relying purely on capital growth. The yields matter because it improves your borrowing capacity in the long run. Number 4, micro data matters. Again, I don't just look at the big trends. I check vacancy rates, rental demand, infrastructure projects, population flows, etc. I look at days on market, stock on market. Those micro data factors do matter to me. But that's not all of it. In fact, when I first started this YouTube channel, I talked about Melbourne 12 months ago before anyone was talking about it. But even in that video, I said to everyone, I don't know if this market will show any signs of growth for the next 12 months because it was a value-based play over a microdata play and allowed me to secure a property at great value compared to if I didn't look at a location with that sort of value. Now, value these days is getting harder and harder to find, but there's still opportunities out there. And ultimately, you must have a long-term mindset. I don't chase quick flips. I don't buy in questionable regional small towns. I focus on holding the long term. I focus on holding the property decades with one day hoping to pass it down to the kids if they wanted to. Right? The goal is to build something sustainable. And honestly, property flipping, it's too much of a hassle, too much of a drain. I don't want to buy and sell properties every 3 to 4 years. That's just too much of a headache for me personally. I buy, I hold it, and the longer you hold it, the more benefits you reap. Simple as that. So that really covers my fundamentals, right? Of why I invest, how I invest, what I look for, etc. And I think a lot of people align with me. I think a lot of people don't see how I see it. That's okay. Everyone has their own opinion towards investing. That's what makes life fun. But my final thoughts, especially with all the videos happening these days, markets rise and they correct and then they rise again. You can look at this time and time again. Historically, you can look at property prices and suburb prices. They rise, they fall, they rise again. But fundamentals, they win over everything. Not the hype, not the social media post, etc. Corrections are normal and they're healthy and they shake out speculative money and reward those who invest with patience, discipline, and a plan. And for those who are thinking about, oh, the property market is going to crash in 27, 28, and I'm going to buy then, we don't know that for sure. Yes, it may seem like it may seem like we need a correction during that time, but there is still a lot of money to be made between now and 2028. Of course, you need to assess that with your own risk appetite, but in my personal opinion, that's how I see it. And I want to stay out for this is that seasoned investors know the dangers of borrowing too much. They keep their debt in check so a downturn doesn't wipe them out. They invest smart, they invest slow, they invest with patience, they diversify, and they don't get emotional. Investing is on facts, figures, data, and knowledge. That's it. Invest smart or don't invest at all, guys. Thank you very much. Till next time.